So we are talking of financial analysis of annual report or financial performance of the firm. First, and part of analysis is short-term financial analysis. For that purpose, we use the liquidity ratios. Liquidity ratio comprises of different sub-ratios like current ratio, which is ratio of current assets and current liabilities. Ideally, we believe it to be 2 is to 1, 3 is to 1, 4 is to 1. This kind of ratio is seen as one of the ideal ratios or standard ratios. Then there is another ratio which is quick ratio or acid test ratio. When we subtract inventories from in current assets, then we get the liquid asset in the numerator and divided by current liability, we get the quick ratio. The ideal ratio should be 2 is to 1 is to 1, 2 is to 1. That is okay. Then there is another ratio under liquidities, which is cash ratio. Now cash ratio, we include only cash and bank balance as well as marketable securities in the numerator and divided by current liabilities. So we are becoming more and more specific in terms of current assets to find out to what extent the liquidity position of firm is in the short run. Liquidity position tells us, explains us about the short-term financial position of the firm. The second quadrant of financial analysis is long-term financial analysis, means what is the chances of the firm to go bankrupt or liquidate or to become insolvent, to long-term financial position is sound or not. So for that purpose, we use different indicators in the form of calculating ratios. First one under and in total we call them as leverage ratios. So leverage ratios are primarily meant for finding out the long-term financial performance of the firm. So for that purpose, we use first ratio as debt equity ratio. Debt equity ratio is a very important ratio where we take in the numerator the long-term debts or bonds or debentures being taken by the firm, and in the denominator we take shareholders fund. In shareholders fund, it's not only equity, it also includes the reserve and surplus as well as the profit of the firm for that year. So in total we take the shareholders fund in the denominator, and in the numerator we take the debentures, the bonds and long term loans. So tells us this tells us. Yes, Utkarsh, you want to ask a question? Higher the ratio of debt equity, this is a signal of risk for the company, because this also signifies higher leverage assumed by the company, because its equity portion is one but its the debt portion is more. So higher debt equity ratio may be of range of 6 is to 1, 7 is to 1, 8 is to 1 or above. It is seen as little risky for the firm, because it may be possible a firm is not able to earn good amount of profit, it may not able to return the interest on the loans which it has taken, so there may be insolvency risk for the firm to face. So debt equity ratio ideal, it is assumed to be 3 is to 1 or 4 is to 1, ideal debt equity ratio. Then second indicator in leverage analysis is interest coverage ratio. Now interest coverage ratio shows that to what extent the operating profit is able to cover the interest obligation of the firm. So here we take operating profit in the numerator and interest burden of the firm in the denominator. This shows that if 1 rupee against 1 rupee of interest burden on the firm, what is the total operating profit being earned by the firm. Higher this ratio, better the long term financial position of the firm is. So this is the two important ratios which come under leverage. There are many more other ratios which we can calculate, but for the time being these two we can understand. These are fundamental ratios for the purpose of gauging the long term financial strength of the firm. Then third one is the efficiency of the firm. Efficiency means to what extent the firm is efficient in its normal routine or operational activity. The firm is able to utilize its assets for the purpose of creating or generating sales. So normally by the word itself suggests that here we are going to use sales as one of the indicator, or in place of sales we also use sometimes cost of goods sold. So efficiency ratios are there, like asset turnover ratio. Asset turnover ratio is the here we take in the numerator as cost of goods sold or sales. If cost of goods sold figure is not available, then we can use sales figure in the numerator divided by the assets. We can take gross assets or net assets. If it is gross asset, then the name of the ratio will be gross asset turnover ratio. If it is net asset, that is fixed assets less depreciation plus current assets, then it is net assets. So this ratio tells us to what extent we are able to rotate our assets or convert our assets into sales. How many times we are able to convert our assets into sales. So normally in case of services company or software companies, this ratio happens to be more in comparison to manufacturing companies, because they have heavy investment in their fixed assets in comparison to a service sector company. So this asset turnover ratio tells us the efficiency of usage of our assets. Then coming down, another indicator under efficiency ratio is what we call net working capital turnover ratio, NWC, or working capital turnover ratio. So here again the same thing, sales in the numerator or cost of goods sold in the numerator divided by net working capital of the firm. Now this tells us to what extent we are able to rotate our working capital in the business, that is creating sales for the business. So this also tells us the efficiency of working capital for the firm. Then another one is inventory turnover ratio. Inventory turnover ratio, the formula is same, cost of goods sold oblique sales. You can use either of, divided by the average inventory of the firm, opening stock plus closing stock divided by 2. So this tells us how many times we are able to rotate our inventory into sales, the efficiency of usage of inventory. So higher the ratio is, better the firm is, more vibrant the firm is. Then there is another ratio which is debtors turnover ratio. Debtors turnover ratio is again same, numerator sales or cost of goods sold divided by debtors. So this tells us how many times we are able to convert debtors into sales. So another way of looking at inventory turnover and debtors turnover ratio is in how many days we are able to convert inventory into cash. So we call it as inventory conversion period. Inventory conversion period. So that is nothing but reverse of inventory turnover ratio multiplied by 360, if we assume 360 days are in a year. So this is 1 divided by inventory turnover ratio multiplied by 360. This gives us inventory conversion period. This tells us in how many number of days the firm is able to convert inventory into cash or sales. So lesser it is, better the firm's performance is. Similarly, in case of debtors, in how many days, if we want to know they are converted into cash or they are making payment to the firm, so then we call it as debtors collection period. This is inverse of debtors turnover ratio. Just like we have seen in case of inventory conversion period, in how many number of days inventory is converted into sales. So it is inverse of inventory turnover ratio. Similarly, in case of debtors conversion period or debtors collection period, we take inverse of debtors turnover ratio, 1 upon debtors turnover ratio multiplied by 360. It gives us the number of days in which debtors are making payment to the firm. So lower it is, better the firm's performance is. So there are many other indicators in efficiency ratio which we can think of, which we can use for analysis, but these are certain fundamental indicators, these 5-6 fundamental indicators in efficiency ratio, which tells us the performance of the firm, the routine performance or operational performance of the firm. The last one is what we call profitability of the firm. In profitability of the firm, we can measure it from two aspects. One aspect is in terms of profit, we measure in terms of sales. Second one is profit, we measure in terms of investment. When we measure in terms of sales, we get 2 or 3 indicators. One is net profit margin, which is net profit divided by sales multiplied by 100. Then gross profit margin, gross profit divided by sales multiplied by 100, or operating profit margin, operating profit divided by sales multiplied by 100. So this is these are profitability ratios from the perspective of sales. Then there are certain profitability issues or profitability ratios or indicators which we can calculate from the perspective of investment. So like return on investment. Return on investment we calculate from the perspective of operating profit, or we can also calculate it from the perspective of profit after tax or net profit. So it is operating profit divided by uh, shareholders fund return, or total investment. So many times we take total investment as investment through bond or equity, investment through long term loans, and equity investment in the fund. So this gives us return on investment. So higher it is, better the firm is. Then there is another ratio which we call as return on capital employed. Return on capital employed, or we can take it as return on net worth. Capital employed and net worth both are same. So this is nothing but the operating profit divided by the net worth of the company or capital employed. So capital employed we take it as equity, profit, and then reserves and surplus. This represents shareholders fund, and that is also called as capital employed in the business. Then another one is return on equity. Return on equity is operating profit divided by, when we divide it by equity shares, or the equity shares which are paid up. So this gives us return on equity. So we get different perspectives of return. Now in the place of operating profit, you can also use net profit in the numerator. It is on the basis of perspective, and then the analysis and interpretation will be from the perspective of either net profit or operating profit. So that either both kind of calculations can take place. Then there are other ratios also which signifies the return to the shareholder, like price earnings ratio, which in short we call as PE ratio, which is market price per share divided by earning per share. This tells us the ratio between market value of the company and book value of the company. Earning per share shows the earnings capability of the firm, and market price per share shows the reflection of that earnings capability in the market. So mark MPS divided by EPS. Higher it is, better the firm is. Then we have DPS, dividend payout ratio, DPO, which is DPS upon EPS, dividend per share divided by earning per share, EPS. This tells us to what extent the firm is able to give dividend to the shareholders, and to what extent it is retaining the profit. It is not distributing as dividend, but retaining back the profit or plowing back the profit for the purpose of reinvestment in the firm. So this depends on the rate of return and cost of capital. One factor is financially, if we see if rate of return on investment is more than the cost of capital, then the firm should not have higher dividend payout ratio. The best optimal dividend policy in that case will be zero. The firm should not distribute dividend at all. But if rate of return is less than the cost of capital, then the optimal dividend policy should be 100%, means the firm should not retain any amount of profit, it should distribute as dividend. So in this way we have seen the different perspectives of financial analysis from all four quadrants: short-term financial analysis, long-term financial analysis, efficiency of the firm, and profitability of the firm, with help of this ratio analysis. Thank you.